Okay. My clock says it's straight up 12 noon. I'd like to welcome everybody. The 2026 I-29 Mu University Dairy webinar kicks off today with the focus on milk markets with Dr. Leonard Polzin. The I-29 Mu University is a consortium of extension dairy specialists from the land-grant universities in Iowa, Minnesota, Nebraska, and South Dakota. The I-29 Mu University is a multi-state learning collaborative and connects extension dairy staff with the dairy community to share research, information, and management practices through workshops, webinars, newsletters, podcasts, and on-farm tours. To review the archive webinars or for more information about I-29 Mu U, visit I-29mu.com. This webinar will provide an update on the U.S. dairy market and recent federal milk market order reforms with a focus on how current market and policy dynamics are affecting milk prices and producer revenues. The discussion examines the ongoing downturn in dairy prices by analyzing key supply, demand, and trade factors, explaining why prices have declined, why the downturn has emerged at this point in the cycle, and how competing market signals are creating mixed price indications. Dr. Polzin grew up on a century-old Wisconsin dairy farm and received his bachelor's degrees in dairy science and agricultural business from UW River Falls. He completed his graduate work in agriculture and resource economics from Michigan State University. He brings extensive experience as an educator and analyst to the position, having developed and provided programming on topics including market analysis, outlook, and market expectations, risk management, and policy analysis. As I always say, Dr. Polzin, the podium is yours.
Well, perfect. Thank you very much. I'm going to keep the chat box open during the whole conversation here. So I encourage you to get your questions in now. And also if you want to send them to myself or Fred or Jennifer directly, if you don't want to send them to the group, that's fine by me as well. I assume that's fine for you, Fred, but
Ab-
you know,
Absolutely. Yep.
encourage you to ask. So I find that the more questions we can answer and the more focused on the topics and things that you folks are interested in, the better off we can all be here. So and also with that, kind of expanding in scope there just for a second is that a lot of times the questions that people are asking is really what drives a lot of our research too, because that's what tickles the gray matter, if you will, and kind of fun to see what folks are thinking about, or maybe they approach something in a different way. So even if you don't have a specific question for today, but there's something that you're generally interested in, relating to that dairy space, that you've been pondering for a while and thought, hey, it'd be great if we got some more research information out or known on XYZ topic. Feel free to put that in there too. I'd love to hear it and see if we can kind of include it in our ever-growing list of topics and things to take a greater look at over time here. So I'm going to start just kind of briefly looking at and laying out. Oh, hang on one second here. Let's see. There we go. I might have to use the mouse, so apologies if it gets distracting on the screen. We'll do our best to limit that. But I'm going to kind of start with this overall thesis or idea of kind of what's happening right now in this dairy space. So it's been, we'll call it a quiet shift. Sometimes the headlines are making it not so quiet, but definitely a shift. And we're in a supply-led adjustment right now. And part of this is that we see some mixed market signals that are out there and that are kind of conflicting in incentives, right? On that on that producer level, and also a few throughout the entire rest of the supply chain as well. So what's happening is that we're getting these mixed market signals that are misaligning incentives, which are changing decision making, which then kind of becomes this question of what does what does this lead to? Where is this response going to go? Some of these signals might kind of take what a normal price cycle or a normal system that we would see and expand it quite a bit. So if that is the case, then what does this look like for extended low price periods? I do want to start off by saying that I fundamentally hope everything I say in this presentation is wrong. Because if it is, then I think we'll all be better off. So, we're, as I like to say, don't make the news, just report it. So we're, sharing the facts, the figures, the numbers, the trends that seem to be apparent. And, as far as any long-term projection goes, who knows, right? But we can at least draw some insights and try to make some informed decisions now on the things that we're seeing and that might be coming down the pipeline, and that's kind of our goal here. So, this is very specific to today. So before we get into the markets things, we're going to start on the policy front. Very specific to happening as we speak is that the USDA has created or issued their final rule in their Federal Register for the dairy margin coverage revisions that happened under the One Big Beautiful Bill to become effective today. So the big question there is, what are those changes? So normally we would have this policy, DMC, dairy margin coverage, come out and be under the umbrella of the Farm Bill. This time, seeing as it seems to be a contentious issue for the Farm Bill to get through, it was included in One Big Beautiful Bill, or OB3, if you will. So what that did is it did reauthorize the dairy margin coverage program through 2031. And the big thing here is that I don't want to get too lost in the weeds on this. More or less, it's the same, right? There's two big things I want you to keep in mind that have really changed. The first of which is that you can update your production history. So you can update it based on the highest marketing milk production from 2021 to 2023. In the statute and the legislation, as the way that I read it and interpret it, is it says that it uses the words like may or can, which means that you do not have to. So if you, and again, check with your local FSA office and make sure that that is, aligned with all of the other policies. But everything that I've heard and read, that seems to be the interpretation, is that it's not a mandate to update production history, but an option to. The other thing is that on that tier one coverage level, which historically was that first 5 million pounds, we're going to go to 6 million pounds. And so that way there's more coverage available there. Premium rates are going to stay the same. The calculations are going to stay the same as far as feed costs, things like this. You do have that 6-year lock-in option that does give you a discount in premium. So there'll be more information coming out on DMC as we go along. There is no enrollment period announced right now. The One Big Beautiful Bill creates the reauthorization of the program with these changes. So, and today is the date that that rule becomes effective. So, the big takeaway from this is one, think about your production history. Two, if you want to update that or not. Two, know where your pounds of production are so that way you have some idea if the new advanced tier one coverage is something suitable for you. And three, be on the lookout for those enrollment periods, those enrollment dates. This just shows those premiums as they kind of go along here. As you can see, they're not changed, but as you get to that red color, that tier two, premiums do increase per hundredweight. One thing I encourage you to think about, especially right now, is as we kind of look towards the future here, kind of weigh, a lot of times people just kind of throw their hands up and call it good. And after they get past that tier one coverage level, do the math, right? If you have other risk management options out there that you're considering, see how they compare at least. Not always, but every once in a while, one may become cheaper relative to some other options. So at least take a look. Uh, all right, so kind of getting into the meat and potatoes of things here is that at least the way that I've been seeing this and interpreting this is that we're getting kind of some mixed signals. There's some big main signals that say, hey, maybe we should be, you know, looking towards lower prices. And then there's some other things that are saying, hey, milk prices are weak, but we're seeing, continued expansion, right? Those two things simultaneously usually do not happen. So that's interesting, something we'll look at. Also, our concentrated growth is slows our supply adjustment, and we'll get into that as well. We're getting these rising components in milk production, and we're kind of creating this phantom supply. The other thing is that right now our beef prices are high, and the big question there is what is that doing to milk prices in terms of keeping animals around and in that production system? Because I think right now there's a lot of beef calves, those terminally bred crosses, that are paying the bills. So it's kind of hard to walk away from that. Also, what does that do when it comes to this if we'll answer this question in a second, but if we are in a price cycle, what does that ability for these beef terminally bred calves to pay bills do for the industry as a whole? What does it do for supply adjustment? What does it look like as terms of some of these cyclical natures? Cheese price is weak or holding, and whey is fairly strong. We'll dive into some of that. And our class three supported on somewhat fragile fundamentals. So I think that's kind of interesting. And again, all of this gets back to that real big question of how do we interpret this and where do these cycles change come from? Are we at the beginning? Are we at the end? Is it even a cycle? So I think to answer that first portion of it is what changed. I'm sure some of you have seen this or something like it. It takes a look at where our processing capacity is occurring in the United States. So this looks at from 2023 to approximately 28-ish on announcements and when things are coming online. I stopped counting on this map at about $7 billion of new investment. I've heard estimates. I think the more credible higher end estimate is at $11 billion. I've heard the number 12 tossed around, but kind of on that top end, I'd say is at $11 billion in new investment. So let's frame this for a second. If we take a look at historically milk production grew for the last 20, 30 years, milk production would increase about 1.5% per year, right around. There's a variance there, but within that range. And then as we saw that milk production increase, then we would see the processing increase follow. So kind of production-led processing. And then the processing kind of increased at about that same percent increase, right? Anywhere from 1 to 2%. And this for a very long time period, 20, 30 years. I did it for a 50-year time period as well. And again, we're at, right around that, 1 to 2% range change in both supply growth and in processing capacity. But also during that time period is we saw about $1 billion per year. On a bigger year, it would be about $2 billion in investment in dairy processing. Let's think about what this means right now. Right now is from 2020, let's call it 2024, 2020, late 23, up until approximately 2028, is we're having $12 billion of investment. 11. Let's round that down to 11. So if we're having $11 billion of investment in just a few short years, we're kind of taking a decade's worth or more of processing capacity and condensing it down into this tight time window, right? So, and that's what I argue, at least, is where I think things are changing too is kind of a new fundamental baseline. I think we're going to have, that this processing investment is going to be a structural shift and not just a change in along our supply curve. So if that happens, then that means that we kind of fundamentally need to find new price ranges on things. And I think that's where the market is trying to figure out now is what does that look like? Um, and also, I think there's some big, large implications going forward as well, kind of related to this, how our industry and supply chain is going to be setting itself up as we go forward. If you kind of squint and look at this graph and hold it, one or two arm lengths away, you can sort of kind of maybe make out that there's a T in the processing capacity here across the United States. We have some in the central and we have some kind of across the northern portion. This is our recent cow number report that came out, and where the cows flow to where the processing grows. So you can kind of see that T again. Where we're getting this new processing capacity is where we're getting the cows. Which to me speaks kind of directly towards some supply chain coordination that happens now between that producer and processor. Um, so the way I want you to think about this is that historically, dairy farms would grow, we would have increased in supply, processors would grow once that additional supply was there, right? And it kind of happened on that producer-led side, that milk supply side is what was that, we'll say, leading indicator towards that getting that processing response. Now that's flipped. As time has went on, not only has this flipped, but the kind of that market power between producer and processor before was producer heavy and switched to processor heavy. You're right. And we're kind of seeing that same as far as where growth in the industry is happening is now that it's processor led. So what that means is that the places that we're going to see growth, in my estimation, in the future, as far as cow numbers go, are going to be directly correlated with where that processing capacity happens. And I think this is that first evidence of that. The other portion of this expansion is that normally when we have rates of growth and supply, it's from a margin response. Producers have money, right? Right? And what do producers do when they have money? Not pay taxes on it, right? So they reinvest, they expand, they buy equipment, they become more efficient, they become more productive, these sorts of things. So as that kind of process is happening and folding out here, I think we're going to see some interesting things coming up. What I argue is that we are seeing this shift in supply curve. So normally, I'm going to skip ahead on this. I might come back to it here in a second. But normally, and apologies for those of you that didn't sign up for an Econ 101 course. We'll get through it together. But normally here, when we see these supply and demand responses, these price and quantity changes, they're what we call along the supply curve, right? So this orange line here, this blue dot, normally we would see, if quantity changes, we would kind of slide down this curve. If quantity decreases or if it increases, and we would see this response from on that price side, right? What I think is happening is that we're seeing this complete change in supply. So we're no longer along that same supply curve, we're shifting it out. What does that mean? It means that before, if we were at this, for this sake of this graph, $2 price, our quantity is going to be, somewhere here, let's call it $12 or 12 in quantity. Now, if we're going to be at the same price level, we're going to be at, say, 15 in quantity. Don't take this as an exact, right? This is just in theory. But the big thing to take away from this is that if we are fundamentally shifting that supply curve out, that means that then we're used to seeing prices along that previous supply curve. Now we need to find and establish new prices along this new supply curve across the entire market. So I think that's looks to be, if not where we're at, where we're headed, which kind of again brings me back to some of these points here. Is that if we have a shift in supply curve triggered by capacity, sometimes policy, the new plants are driving the demand and the output, and we're now in this kind of new phase where our historic things that changed the supply growth or the supply and demand balance aren't going to do it. Um, so as this has happened, well, like I said before, is that it's before our price cycles are margin dependent, right? So if you high prices cure high prices, low prices cure low prices, and that expansion was based on dairy farm margin. Here it's based on processing availability. So if you have been wanting to expand for a while and couldn't, you're just kind of sitting on the sidelines and waiting for your time. And now when the processor comes and says, "Hey, we need X amount of milk on Y date, are you going to do it?" They give a thumbs up because that's their chance. So I think that changes also how we're going to see some of these supply responses on that producer side when milk price gets low, because it's going to take longer, because we're where that new supply is happening already has a home, and it's harder for that whole structure to adjust to kind of some of this more fixed response and fixed investment that we're seeing, both not only on that processor side but on the producer side as well. So that's at least my argument, is that we're kind of looking at a new kind of structural change in where we're at. And if we're doing a shift previously, what we would see is that there'd be a milk price change. We would adjust output within herd size, existing facilities. Sometimes you'd see a feeding change, something like this. And our time horizon was somewhat short run. And then, we would supply demand adjust, we find equilibrium, we kind of find where a new price point is. But if we have this shift in supply, we're more structural, our cost changes, the herd size and the capacity and productivity, all of these things change as well. Our time horizon goes from a short change to a medium or a long run time period, where not only for the shifting, in order for prices to get back to previously where they were, but also for all of this to happen and take place, right? It's a kind of a long time horizon for the new processing capacity to come online, for kinks to work out the system, for some plants will be sunset, other ones will be coming online, but it's this entire process that's happening as we go along. So the big question then is, what does this look like for our pricing? These are CME values, Chicago Mercantile Exchange. Let's take a look at that class 3 average price is $16.79. Our class 4 is $15.47. I think that's probably below the cost of production on more than a few farms out there. So the one interesting thing here is that we still do have premium as we look towards that backside of that class 3 curve. So what that does tell us is that there's some chance for some risk management opportunity there. I realize that taking advantage of some of these opportunities, even if you're below cost of production, is not exactly a producer's favorite thing to do. Fully get that. But it's that choice is still there. I think it's at least an option to consider. We did have kind of a bump in our cheese price here since the last time that I took a look at this, or sorry, since the last few weeks, but cheese was having a bit of a moment there, was struggling a little bit, did come back up a little bit. But the old rule of thumb is that if you take average block cheese at $1.66, it means you're at about $16 milk. So if we're kind of taking a look at the year ahead, I think if we get this 16 to 18 and we're able to stay there, And if we can average that for the year, I think we would be doing really well. Keep that in mind. I think it's going to be a hard year ahead, and I think there's a lot of things to look at and consider, kind of when you're making those risk management decisions and when you're thinking about, where some of these forecasts are going to be. So this phantom supply, we saw that as cow numbers were increasing, here, this whole right side increase, what I think is interesting happened when our cow numbers were down. And during this whole, I think it was about here in that graph, is when the first report came out that heifer inventories were lower. So we went through a very, prolonged period here of having known at least low heifer inventories, and then we still shot up in cow numbers. So the argument I make there is that I would, if from that producer standpoint, I'm not sure that I would use heifer inventory numbers as a proxy for ability to grow. Because it seems like that is not the biggest factor in our cow number growth. So I think some of that is because of our internal ability to raise heifers. So for example, if you're a 5, 10, 15, 20,000 cow dairy, and you're already terminally breeding animals, it doesn't take that much of a change in your breeding protocol in order to make 5,000 more heifers. I'm not saying that heifers are cheap. I'm not saying that they're, easy to go out and just go to your local sale barn and get a semi-load. Certainly not. But I don't think that that's the limiting factor if we're going to take a look at where herd growth could potentially go in the future here. Also, we're getting increasingly efficient all the time. Our milk per cow is going up, which means that our total U.S. production this year, especially in 2025, has went up with those added cows, more efficient per cow, and we're getting more fat and more protein in our milk all the time. The joke I like to make is that pretty soon it's going to be really good news for the dairy producer because they'll be able to be the entire supply chain because we'll have so much components that the milk will just come out as yogurt. So I think in my lifetime, we're going to be above 5% fat. I don't see where any of this is going to slow down. Even if there is a market signal that says, hey, we don't need as much fat, we don't need as much protein, I think we're already headed down that track, right? We've been breeding for this for quite some time, and it's pretty difficult to just change on a dime when we already have animals in the system that are currently milking, that are still producing offspring, that are even say bred right now towards producing more components. So I think we're going to continue to see these components in the future just continue to increase. We may see some change in feed, right? Adjustment, things like this that might pull some of that down, but I think as a baseline kind of fundamental assumption, pretty easy to assume that we're still going to keep increasing all the time. And this phantom supply that I'm talking about is that in 2025, we had a 2.26% increase in milk production. But if we just on a calculated basis, so this is not the actual amount of solids, this is if we just do, multiply our averages and then come up with a calculated monthly U.S. fat and protein pounds, we had a 4.07% increase in solids. So 2% increase in milk, and we had a 4% increase in solids. So a pretty big jump, which means that also when we look at new capacity that's needed out there on that processing side, we're going to need fewer cows to fill it simply because we get so many more solids per cow. So the big question then is where is all of this milk going? Where do we think it's going to go in the future? Right now, total U.S. dairy exports are looking pretty good. We have cheese and our butter fat are the two that are really kind of leading the way there. But one thing I want you to think about is that when we look at export markets, very, very seldom when we are selling into the export market do we do it at a premium. And that is certainly not the case right now. In order for us to clear our export product, we need to sell it at a discount. So we're very fortunate that we're clearing product right now, that we're not building inventory domestically. But when we do think about international markets, we clear a lot of product. It's hard for them to be very price supportive in the fact of, driving high prices. Why is this important? Right now, we're at 16% of U.S. milk solids exported for 2024. I think 2025 is going to be a bit higher than that. But with the additional processing capacity that simply we need to clear that much more product, we're going to see this increase, right? Why that matters for you. If you're a lender, if you're a producer, talk to your processor, find out the products they are making specifically and where their marketing channels, retail channels, however they're selling their product, right? Because I think as we go forward, we're going to see even more variance in basis in producers' pay price, from one side of the fence row to the other, because of how different processors, different utilization, things like this affect pay price. So if your processor is more closely linked or participating in that export market, I'd really encourage you to be aware of that because that's going to influence your milk check more than somebody else whose processor is more domestically focused. But again, I think this has to increase as we go along. This is just historic averages. Cheese, we're about 6% of the our production exported, 16% of the world's production. And as you get to those other secondary products, that's really where a lot of our production of those products has to go out of the country. So before we get to that, on this export part, one thing that's been very interesting is that we saw about a 4% increase in world milk production recently here. So as that's happened, and we're still able to clear product. And I think that's been a very good sign. But the big question is, what happens when we get to quarter two, quarter three of 2026? Because for the first quarter, we probably still have exports booked. They're probably still moving. But what happens as we get further out when our other export competitive countries have product, have inventory, have things that they need to move simply because their increase in production is happening as well. So I think that's the big question right now that we need to ask and we need to think about. And at what price levels are we going to clear these products internationally in order to make that happen? Cheese production, you can see in that top left, we did see, we're starting to see this line go up. We're starting to see an increase there. The good news is that our stocks, our inventory here are down on that top right graph. And a big reason for that is right here, our total cheese exports. We've been clearing cheese and it's been, leaving our borders. So Mexico has purchased an awful lot of cheese, as well as some other very good buyers that we have. Domestically, all things considered, our domestic market is strong, and we are, clearing things. Good stuff is happening in the dairy space domestically. But the increase that we're going to see in processing capacity, at least based on the numbers that I see, is going to be bigger than that domestic disappearance, right? That is growing or existing there. So something to think about. When we take a look at our cheese price here, this is our NDPSR, National Dairy Product Sales Report for our cheddar cheese price. And I think this isn't a surprise to anybody that's kind of active in the industry. We've really tailed off here this last part of 2025. So, if we're booking exports here, that's great, but then hopefully we can move product. But also we've been decreasing in the quantity sold, which is this blue line as well. So that's always the question is if prices are going down and our quantity selling is going down, that means that people are waiting for a bottom. And the other thing to think about here too is that if you are a purchaser, if you're purchasing butter, if you're purchasing cheese, and you know that right now you're in a soft price environment, your propensity to contract, right? Your propensity to make the risk management decision is less, right? Simply because you know that right now prices are low. The future looks like prices are going to be low as well. All of these other market factors are happening. And what happens then is that when that contracting happens, we see it works to kind of smooth out some of these volatility in pricing. Well, if there's less contracting happening, it means that we have this potential for more volatility in the short term. So from that risk management standpoint, and also when we do see these structural shifts and changes, we often see some increased volatility as well. So I think as we come into 2026 here, I would be watching for opportunity, even if it's not like the best, the highest ever. But if there are, small things that you're able to capture through some of these price changes, might be a good thing. Our whey market right now is really doing a nice thing for that cheese complex. But if we kind of break down the whey complex in and of itself, a lot of this is led by high protein whey. So, we're seeing high protein whey come up in all kinds of things, from coffee creamers to, all of our sports drinks, not only powdered drinks, but, new canned beverages, things like this. So I'm waiting to see when we can have a high protein sucker or a high protein throat lozenge, something like this. I think the day is coming according to all the new sort of innovative products that are using whey protein right now. Um, I I think that when folks ask me like, where's the future of this? At least from the basic fundamentals, to be able to process high protein whey takes a lot of infrastructure, takes a lot of capital, right? So, and do I think there will be some increase in our high protein whey output from the new cheese capacity that's coming online? I certainly think so. Will it be enough to completely flood our market on that whey side? I don't know. I am less, I'll say if it was me, I would be less concerned about the whey market, the high protein whey market dropping rapidly than I would be the cheese market. I think the cheese market is certainly going to see the response from this more than what that high protein whey space will. So in some ways, that's good news for that class 3 price because it will be somewhat price supportive. Big question is if it will be enough. If we take a look at butter, we saw this increase in butter production and butter exports. But again, cold stocks, our inventory is within range, and our domestic disappearance, I would say, is within normal range as well. Slightly up, but within normal range. So we've been doing great moving product internationally there. And a big part of this is this price, this $1.43. So, and we've been coming down. I've been asked for a long time, when do we think we're going to see this class 3, 4 price inversion happened? And well, it happened, right? For a long time, butter was, if you took a look at like all milk price, butter was really doing a very good job of holding that up. As soon as we got increased production levels, even with our exports, we still saw this price decrease. So, if you're selling into that class 4 space, I would watch very closely and find out where your processor is, depending on where they're clearing their product, so that way you can kind of watch those factors accordingly. On our dry products here, more or less the same story. We've seemed to found this lower range, at least for prices, and we don't seem to be continuing to drop. And this is that world change in milk production that I was talking about. We're seeing this, 4.2% increase in our global supply from our key exporting dairy countries. It's hard for me to express how abnormal this is. For all of the years that I've been looking at this graph, I have not seen a graph, or I've not seen this high of a percent increase over this period of time. And somebody out there I know is wondering, why? Where is this coming from? I would say that let's think about Europe. There's been so many years where they've had non-optimal output conditions. Anything from weather to the energy crisis. For a while, they had that fertilizer issue and high prices. There was in France, they had the protests from the Green New Deal proposal that was coming out. They've had blue tongue in reported cases in the eastern part of the country. All of these various headlines, right? And all of this milk production is not equally spaced across the entire EU. So Ireland right now is really what's kind of leading the way in this milk production, and a lot of that's because they just have impeccable weather, and they're kind of finally had a time period where they haven't had something impeding on their production ability. So, and they've also had some previous periods of fairly good margin. So, they're going through that kind of normal natural cycle of increased efficiency, increased output, intensification, things like this. So that's kind of where we're seeing a lot of this increase in milk production come from in that world stage. When we take a look at world prices, I don't encourage you to anchor yourself so much on the number as the direction the lines are going. So the green is the United States, and you can see that our milk price is quite a bit lower than the world milk price, and it has to be, right? There's no way that we can sell product in the international market and be competitive if our price isn't world price minus logistics minus headache, minus effort, right? In order to get to this into our United States price comparable level. So keep that in mind as we go forward. Is that we're still selling at a discount. We likely will continue to, and as our supply domestically increases, normally we see this spread between U.S. and world price increase as well. So all else equal. So just quickly here, I do want to run through some of these federal milk marketing order changes and what we've initially been seeing here. The big thing I want to take away from this is that a lot of these federal order changes are from a supply or from a market response, right? The market has changed, things continue to evolve. And the hearing in the process was a response from that. So, right here we see where I'm sitting right now is the Upper Midwest order, Federal Order 30, and where not all, but some of the participants here, it looks like we're either in Federal Order 30 or Federal Order 32, the central order, and we try to have all of some information and updates for both of those orders here. A big reason we had the hearing was kind of a response to some of the symptoms that we were seeing. We were seeing depooling, declines in premium, reblending, negative PPDs, things of the like. So for maybe 5 minutes here or less, we're just going to kind of take a look at where some of these numbers are coming in at right now, because we've had this time period now of pre-implementation. Changes have now been implemented, the last of which was done in December of 2025. And for some of these changes, we now have data and information, so we can maybe say, hey, is this policy acting, one, as expected, and two, is there anything that we missed or anything else to consider, right? So a big part of how your operation and your milk check is impacted by the federal order changes is through the utilization for your milk. So the higher processing, the more utilization that goes into those processing classes, class 3 and class 4, the greater the decrease in your pay price was, because that manufacturing allocation called that make allowance decreased or had that greater effect on your pay price. So, for example, here in the Upper Midwest, we're very heavy class 3 utilization. A lot of our milk goes to cheese. But if we get to the central order here, we see kind of a greater mix in how our product is being allocated across classes. And as that happens, then kind of these changes of mechanics of the federal order math that have happened do influence your pay prices. Di Mathematically the same, but the impact on your actual check you receive is can be different, right? Simply because you have more of that class one, class two product going in, specifically that class one. And then here's the East, just as a good representation of utilization. Sometimes in history they get pretty evenly distributed, sometimes not. Um, One of the big symptoms here that we were looking at is depooling. This gray bar tells us when the federal order changes went in place. And I would say, at least anecdotally here, it looks like for Order 30, we saw a change. We've seen increased in pooling, at least from Minnesota and Wisconsin, in participating in that pool. When we take a look at where central order is, Order 32, at least here, it doesn't seem clear. It looks like that we've seen some decrease in pooling participation in some states, and in a few of them, some increasing pooling participation in 2025. So, as we kind of take a look at where this percent breakout happens, I would say that for Iowa, based on the math that was available to me here, again, when our implementation date went in June, this is our 2025 line, is this red line. We have seen an increase in pool participation. So a lot of this is too hard to say definitively yet, but at least at surface level, it looks like for Federal Order 30, for Federal Order 32, we've seen an increase in pool participation. So potentially, maybe this policy change has helped address that. Declining in premiums. This red line here is our implied premium. So this is implied premium for Order 30. The way that you get implied premium is that you take your mailbox price minus your blend price at test. And then this blue line is our manufacturing cost index for cheese. And we had this big general decline over time here. And then after implementation, we saw this big spike. I wouldn't say that this big spike in overorder premium is inherently from the federal order changes. The reason I say that is we've seen these big spikes before, so it's hard to say that it's directly related, right? There could be some additional market factors that are influencing this. So the big takeaway there is still too soon to tell. PPDs. A PPD is the uniform milk price per hundredweight minus the class 3 component values. After implementation, we did see a bump up, and now we've seen a bump down. Let's take a look at all of the orders, 30, 32, and 33. Again, implementation timeline here. We certainly saw an increase shortly after. Now we're coming back down. Again, I would say too early to tell definitively if that's the reason, or if federal orders have increased or decreased where that PPD is. The one thing that I do want you to know is that when producers were voting on the federal orders, the choice was not, do we keep federal or do we go back to what federal orders were without these changes, or do we keep the changes? It was, do we keep the changes or do we not have federal orders? And chose to keep orders, right? And by doing so, we do see this increase in producer pay price, because without having orders, we would not see this for 2025 and Order 32, we would not see this 47-cent increase, even though it's negative now. But over the course of the entire year, we would not have seen this 47 cents additional PPD to producers. So something to think about. Class 1 differentials in Order 30, we certainly saw a big increase. I did look at the central order same variable here, and it did have an increase, not as dramatic as this, still within range, but I do think that still the verdict is out on that as well. So, all things federal order, the big takeaway there is, where is this? Where is it landing? How is it operating? And I'd say more or less as expected thus far, but we need to see a little bit more time yet in order to say definitively. I see there's a question, to what extent does a beef on dairy crossbreeding trend cushion dairy farms' revenues as milk price goes down? Good question. What I will say is that from the kind of back of the envelope calculations I did with producers, um, uh, historical financials that I've taken a look at. Historically, uh, revenues derived on the dairy farm from the beef market. So think culls, terminally bred animals, bull calves, these things, right? They were single digit percentages of total revenue, right? Um, on some of these that I've looked at, we're getting to double digit percentages of total revenue derived from that beef market now. So I think that is probably the easiest way to think about um, where this is cushioning some of those, supply changes that we might see because if that percent of revenue increases, it means that we're paying a lot of bills, which means that it's hard to make those production changes or decisions. So, and part of that is depicted through this graph. If we take a look at semen sales, this is domestic beef, this is domestic dairy. And as time has went on, we're definitely seeing the adoption of it. And again, I wanted to talk a little bit about this inventory. I think we did probably enough already that, hey, even though we've seen this, inventory number go down and down over time, obviously something is happening that we saw this response. So again, I think that's a lot of internal coordination. And when you have large dairy operations that are able to do and make these changes and adjustments, I think that's why we're seeing these changes in the graphs coming in here. So the big takeaway on all of these inventory and replacement numbers is that even as this trend line goes down, I don't think it's going to be able to act as a proxy for growth in the future. I fundamentally don't see how that is going to be a thing because it has not so far. So I think we're still going to see increase in cow numbers. We're still going to see increase in milk production, all of these things. Um, so what does the new normal look like? I think historically markets don't return to peak profitability until we start settling into these kind of lower average price troughs and that happen, kind of after the expansion phase happens until we're seeing where a lot of these things kind of settle down at as far as how much product is coming on the market, where does our product mix look like, are we able to get those international buyers and on a regular basis, all of these questions. I think you could expect greater inter-year volatility and also this wider dispersion of outcomes across producers. I think depending on where you're going in your manufacturing class, depending on where your milk falls in that utilization, even very hyper local differences in basis on that milk check, I think we're going to see kind of in that coming year here. So again, profitability is cost control, timing, risk management. Dairy has never been easy, and I don't think it's going to get any easier. And I don't think that this year will be particularly easy either. I know it's easy to say risk management, but I'd really watch if we can get some fireworks on volatility, then it might be the ability to at least do some risk management on that. So uh, I'm gonna kind of skip this quick and do one more thing, so then get to the next question. But when we kind of take a look at our supply and demand factors, this is some work done by Christopher Wolf at Cornell. When we saw good years for milk prices, what did it take? So it took a supply change of 1% or less year over year to make a good change with huge increase in exports and a decline in ending stocks. Right now, our ending stocks looking pretty good. So, if we're just looking at that, we might be in a good average year. Exports, so far, we're doing pretty good increases that put us in a good average year. Milk supply puts us pretty firmly in this poor year, right? So if we're looking at 2026, I don't think milk supply is going to change. Puts us in this poor year category. Exports, that's kind of a wild card. We have a lot of other competing countries that are going to have products that they're putting in the marketplace. If we can hit average, I think that would be great. So right now, I think milk supply, we're poor. Exports, we're in that middle of poor to average. Ending stocks, if we can hit average, we're doing great, right? So where does that put us historically in milk production? Which, by the way, I don't think fundamentally is probably going to be a reference point in the future because I think we're kind of going into this uh, very new structural phase. We're high end 18. So, like I say, I think with everything else, cost of production, if we can land in this port average range within here, I think we'll be doing well. Um, I'll let you take a look at this while I go to the next question. Um, is will future processor competition and or specialization create new dynamics? Yes. I do think that um, so I think processor specialization is going to be very interesting, especially when we kind of take a look at what products people are gravitating towards. Like for example, that high protein thing, right? But also take a look at yogurt. Chobani is investing a lot into a facility in Rome, New York. So if you're, selling into that market, that product is going to have a lot more to do with your price than say, cheese folks here in the upper Midwest. And as this size of processor increases, I think we're going to see, you're going to have your risk profile change from that producer level simply because of that as well, right? Because if there's more specialization, generally you increase your risk exposure. So, and also like right now, cottage cheese is very popular, very big thing. So we've seen a very large increase in cottage cheese consumption. Um, I know of some factories that are, expanding in that, taking a look at what they can do in that space. Um, I don't think there's anything wrong with that. I don't think that's necessarily wrong, but all I can tell you is that I am absolutely terrible at projecting consumer trends. And whatever it seems like I think the market is heading in a direction, I am normally wrong. So, it's very hard for me to predict where the consumer is going to land and what the product they're going to want and what the next thing is going to be. So, and a lot of these are everything in the dairy industry is expensive and capital intensive. So, which means that you can't turn on a dime. I think consumer trends are always going to drive things. There are always things you have to be responsive to, certainly. But I do think that, as your question asks, I think specialization is going to certainly change, some of that risk portfolio for sure. Can I go back to the list of reasons why you think global milk production is up across different countries? Yes, I will. I just kind of listed them. Some of that is the big takeaway there is that historically, a lot of these countries have been experiencing something that's been limiting, whether that's an input reason, such as fertilizer, electricity, uh, some was policy for a while. They had this limitation on some physiological level, whether that's or weather related, that was kind of curtailing things. There was some disease things, all of this. So they've kind of had this multi-year uh, time period where there's been not one predominant thing, but like something comes in, something changes, and it's just a very mixed basket of stuff that's happening. And for once, finally, they don't have that. So they're able to, ramp up production. And that coupled also with periods of fairly good margin. Because they've had all these other things happen that have changed their supply, their price was relatively good as well, because they saw that supply response. So their margins were were fairly decent, and that gives them some room to expand, to reinvest, to do things like this, right? So we're not seeing the increase in processing capacity or the increase in cow numbers like we are in the U.S. Nowhere near to that, level or extent that's happening. A lot of that is from, more, we'll say, distributed growth and just kind of this rising tide carries all boats sort of thing. I am by no means an EU expert. But that seems to be the message that I've been receiving, and that is being, reported on and shared with me. The one interesting thing too, so Colton, when you asked that question, I think what's underlying that, that maybe you didn't mean to ask about, but I think is very telling, is that a lot of their production has been directed towards cheese. So a lot of this increase in milk production has been going into that cheese market, which means that we're going to see increased pressure in the cheese space as well when we look to export it. So, cheese, I think, when we kind of come back to this graph and take a look at where things are being priced at, I think cheese might come in as maybe more or a brighter yellow than what we have here. And a lot of this just depends on where our production capacity is, when it's coming online, and how we're able to clear it. Right now, our real bright spot, I feel bad putting everything in red and yellow, but so we needed at least some good thing to hang our hat on, is that our whey price is good, specifically that high protein whey. And right here, when we take a look at margins, I think for the time being, I would put it in that middle zone. I'd certainly watch. I've heard some, guest checks come out recently that were in the 15s. So I think we get from, orange to red or yellow to red pretty quick, if that's the case out there. So if we start seeing, mailbox prices hit in that $15 range, then I think we're going to see quite a bit of hurt and profitability issues out there in the countryside. So with that, other questions? I'm happy to go back to anything, touch anything more, anything like this. So uh,
If people have questions, if they would just go ahead and type them into the chat box. I mean, we've still got a pretty good number. Uh, if they'd like to unmute and do it, I guess they could, but
the question was dairy demand from the fast food industry. So if we think about so two things. The restaurant performance index, and then also just generally institutional food buyers, right? So whether that's well, let's refrain from that one for a second. Restaurant performance index, and then our just food away from home in general, and more of this, going from processor to wholesaler to that end user sort of deal. We could certainly see some bump. It's been um, fair, I guess I would categorize it, but we could certainly see some increase there. The one bright spot is that we are seeing pretty good volumes of mozzarella cheese go to pizza. That's been a real bright spot here recently. But our food away from home is holding better than I anticipated. It seems like some of these more macro views on the economy and consumer spending and inflation don't seem to be slowing down those numbers as much as what personally I anticipated. So I don't know if that gets to your question specifically or not, but I hope that at least drives towards it. I think there's always room to clear more product, but we could. Uh, I don't think we're going to we didn't hit any highs in 2025, that's for sure.
I'm going to go back to your EU comments. Do you see those politics, and I hate the word, but sustainability issues that they had? Is that going to move worldwide? Are we going to see that in other areas?
Boy, that's a good question. There is the only thing certain is uncertainty when you look at any sort of policy or politics right now, that's for sure. Um, if we put our policy hat on for a second, right, and we just think in terms of like as an economist for that, right? Policies like that are easier to do in an environment where you have um, economic satisfaction from the breadth of the supply chain, right? Producers are financially fine, well, right? And like there isn't anybody that's that's substantially hurting, right? From the economic perspective. Because then if you make a change, they're able to change, able to adjust, right? Any negative initial implication that comes from a policy change, does not, there's wiggle room, right? Um, Also, it's nice when that happens in a environment and time frame when not only financially there's cushions, but if there's cushions from, outside factors on supply and demand and options for you to clear product outside of your borders or be able to, adjust your supply and demand balances in some way, shape, or form, right? Like if you don't have all of these other constraining factors happening at the exact same time, right? It makes it much easier politically to do these sorts of changes. I think if we get to that point, I think it might come up again, right? But the big thing on the EU is that they're not like the changes that were proposed before is that everything is so segmented and specialized and individualized by country, by area, by type of production system, and like what you do for dairy is not what you do for hogs, and all of these things, right? So it was really hard to create something that was more ubiquitous on that environmental front. So in the short term, I would say I probably wouldn't put a lot of money on it. If we look at this really long term, I would say that I'm going to echo what a longtime dairy economist has shared with me, that he thinks that going forward in the future, that it's going to be very difficult to separate environmental economics from markets and policy economics when you look at the dairy space. The million-dollar question is, what does that time frame look like, right? Is that within our generations that are on this call? Is that, folks coming behind us? Who knows, right? But I think at some point, those two things are going to have to coincide probably more than they do now. But a big question to ask there, and if anybody's in this space and thinking about it, and working in that is where is the burden of that policy lie? Because that's the biggest question, right? In most changes on things, they go what I call down the supply chain. Because if you think of um, end purchaser up here, right? Retail consumer and producer here, your product flows up, the money comes back down. So like a lot of times on these policy changes, they go down the supply chain. If that happens, there, could be a lot of implications. There's cost structure implications, there's size implications, right, like what does that do then to the rate of consolidation? What does that do for burden of proof? What does it do for administrative costs? All of these things, right, that I think are very difficult to answer, but I think we at least need to think about, right, and have, some mechanism at least that if we don't want it to go down the supply chain, that we figure out exactly what that is. Um, HPI AI, yes. One second. So myself, Chuck Nicholson, Dr. Chuck Nicholson, and Dr. Paul Mitchell were some of the first to put out any kind of analysis on HPAI a few years ago now, and what that looked like. So um, it's let's start in aggregate. In aggregate, if you look at the entire United States, uh, I don't, it's difficult to me for me to see where it is going to have an impact on pricing. I think that we're so large, robust in production, that unless we see some outbreak that spans the entire country, it's not gonna impact our our markets, our pricing, our output, anything like this. Um, as a veterinarian told me once, he says it's kind of like the flu. You can either have it for 2 weeks or 14 days. The choice is yours. So like, and I don't say that to belittle it because like we ran economic impact even on like on that farm level, and it is noticeable, it is significant. And in Wisconsin, we worked with some legislative folks to try to get policies put in place to not only incentivize testing, but also if you test to get some sort of reimbursement or some sort of assistance if you do have those economic losses. So I don't know how many states have that, but there are some out there. So like it's noticeable, right? And on that hyper local geography, it does matter. In aggregate, I just don't see where it's going to have any economically meaningful impact on supply. Um,
Dr.
so I
Polzin?
hope that answers that question.
Dr. Polzin, we're kind of down to the end of our time period. I'd like to thank you for sharing this information and your insights on the 2026 milk market. Remind listeners that this program has been recorded and will be available on the I-29 Moo University website. Give me 5 working days before it'll be up. In addition, I will email you when it is available, as well as including the link to the program evaluation. I know we always evaluate things, but it really is important for us to continue to improve these dairy webinars. Thank you for your participation, and I look forward to seeing you at the webinar next month. At this point, I will conclude the webinar. Thank you again, Dr. Polzin.
Thank you.